All right, I welcome you once again as we continue to make progress in our trading journey. So these are the curriculums we've covered so far. We've talked about what is Forex, meaning of Forex, the financial market as it were, what we trade in the Forex market, how we make money in the Forex market. We've talked about base and quotes currencies. We've talked about who can participate in the Forex markets, who are the major players in the Forex markets, where we talked about the big guys, the central banks, the hedge funds, and even people who do buying and selling of international goods and services. However, there are cadres in this thing. We talked about the application needed to trade the Forex market. And like I said in the last video, I said I was going to install um I was going to install, what's the name? I was going to install MT4 and MT5. So this is MT4, this is MT5, yeah, on the PC, and these are logged in accounts. So this is the same account where I took a trade of 0.1 lot size. And as you can see, I've closed the trade because the market did something else entirely that indicated to me that the market was going to sell. Yeah, I could have taken a sell position, but as it were, I'm not here to trade. That's not what I'm here to do. I'm here to teach. And then let's make progress with. So I just want you to know that too, so that in the near future, you're not just going to be opening trades anyhow and then, no, we trade in the markets by a plan. So it's not in my plan to trade today. Hence why I closed that trading position, whether it ended in a profit or a loss, but actually closed it on a break even, that is no profit, no loss. So this is MT4, this is MT5, and there's that. We have it on the system already. We spoke about who a broker is, how to open an account with a broker. And then we also spoke about how to also open an account, a trading account with your broker that you can log in on MT4 or, excuse me, on MT4 or on MT5. So let us take off everything that we've covered so far. Why am I not showing us everything? Well, I think when I mean everything, I mean the entire curriculum. I think I learned that from a mentor I learned from at some point in time. Let's hide every other thing and make it a suspense so you can enjoy the journey as it goes. So the next thing we have to talk about now are candlesticks. Candlesticks. Let's make it bolder. What are candlesticks? But before we talk about candlestick, you see, as Forex trader, what we deal with is the charts. What is the chart? This is the chart. An average layman will see all these things now, and the person will be like, what's all this one? What's going on here? Several ups and down, and long ropes and this and that, and on and on. It won't make sense to the person, of course, because the person has not learned about the industry. The same way whoever is like someone like me, I'm not inclined with anything that has to do with sounds. So, because I have a friend who is like an engineer, and you just see them talking about several things like softwares and, is it 60 hertz? Is this 80 hertz? Is it me? I don't know what is 80 hertz. So the same way I don't know what is 80 hertz is the same way other people too will look at this thing that we call the chart, because this is the chart right here in our front. So other people will look at the things that we call the charts and they will be like, what's this? What's going on here? So the same way they look at it that way is the same way we also are looking at something else that way. But when you learn about it, then you understand it. So basically, the chart is our body. The chart is our friend. The chart is who and what we deal with in the industry to make money. It's as simple as that. No stress at all. So this is the chart. Now, when it comes to the things that we can see on the charts, when it comes to the things we can see on the charts, we have different kind of charts. We have the candlestick charts, as I've written it here. we have the line charts, and then we have the bar charts. Of course, there are different kind of charts representation. However, these are the three that are most popular, like when it comes to the kind of charts. And I'm so sure that it is almost these three you'd see also on baby peeps before they now begin to tell you about, other kind of charts, the Achimoku, Kinkoyo, and all those things. No, Achimoku is an indicator, sorry. Aikinashi. Abi, let's even check self. Where is it? Okay, Aikinashi. Yeah, this is it. So this is also, these are types of charts. But the fact is, even me myself, all these ones we I list for you now, I don't know what to do with them. I don't know what they do with them. There may be other people that use them, but me, I don't. So let us hide this somewhere here and let us look at, or better still, let us pick another page. Let's pick USDJPY. Then let's bring it up. Okay, that's on the yearly time frame. All right, beautiful. So this is USDJPY. Now, remember we spoke about different type of chart, and we said we have the candlestick, we have the line charts, and then we have the bar charts. All of them have their properties. There's nothing that you are seeing here that is random, including the numbers that you are seeing in this place. These numbers that are here, all those numbers that you can see here, where you have this O, H, L, C, some numbers at their fronts, they all have their properties. Remember that currencies have numbers. And when you are trading them, you are trading the fluctuation in those numbers, which is their price. So this is the price of USD 158.364, which also means that you need 158.370 JPY to get 1 unit of USD. Remember that lesson. Good. So let us make progress. So this is the candlestick. And then we have the line charts. This is also the line charts. Mostly, we use the line charts when we want to check for how a price closed. You see this? The market is always moving from one price level to another price level, always fluctuating. Because take for example now, when we checked Naira to USD that time, I think we saw 1532.4 something. Let us check it again to see what we have this time around. $1 to Naira. Okay, I can't remember the figure we saw the last time, but I'm sure it wasn't 1542.16. So what this means is that price of currencies are always fluctuating on the charts. So what are candlesticks? Candlesticks are objects. Before I define it, let us check. Can you see? Candlestick are type of price charts that shows the price movement of an asset over a period of time, the price movement. I'm defining candlestick first because line charts is also a type of chart that shows price movement. But in the Forex market, there's what we call opening price and closing price. Just as we have the Forex market, I'm sure that you all know or should know, or if you don't know, you are knowing for the first time now, that we have the Nigeria Stock Exchange market. In short, every country has its own stock exchange markets, with the New York Stock Exchange market being the largest in the world. However, the Forex market is actually the largest market in the world when it comes to the financial markets. But when it comes to the stock market, the New York Stock Exchange is the largest. So what we are saying is that every asset that is being traded, every financial asset, always has an opening price for the day and a closing price for the day. The same way people go to work, traders also go to work. So I'm saying that when traders go to work and they want to trade, generally, there is a price that the market will open for that day. And after we have traded, and we've closed to work and everybody is going home, there's a price that market closes for that day. Do you get? It's just that we deal in a market that the market is always fluctuating, in a very sharp turn. But take, for example, it's possible that you could go to the market, for example, to want to buy this phone today. And when you went in the morning, the phone was around 245,000 naira. And maybe something happened. They called the person selling the phone that, based on this or that, this phone has become expensive. You can go back to that same place in the evening, and the same phone they called 245,000 naira is now 267,000. So what that means is that for that day, the price of the phone opened at 245,000. But when that day was going to close, due to market condition, the market for the phone is closing at the price of 267,000 naira. Do we get what I'm trying to say? So that's the idea behind opening price and then closing price. So back to where we're coming from. A line chart is now a kind of chart that moves from the closing price of the previous candle to the closing price of the next candle. Do you get what I'm trying to say? Let me make it simpler. We have the bar charts, and where's that one? Okay, this is it. The bar chart is almost not different from the candlestick, in the sense that on a bar chart, you also have the open, high, low, close. You get to know what that means later, but this is the way they are represented. It is almost like a candlestick, but just in a different manner. So can you see this candlestick? They are always moving and forming from the opening price of the assets to the closing price. But for line charts always moves from the closing price to the closing price of the next candle. I'm sure you get that. What I'm trying to say is, let us go to the daily time frame now to make this thing simpler and easier. Look down, you see the dates. Can you see this is Wednesday, January 8th? When you click on this, when you bring the cursor on this particular candle, the thing about all these things is that they all have their details. Now, when you look to the left to this point here on the chart, you realize that as I'm moving the mouse around with this thing called the crosshair, you can see that those details are changing. Those are the properties of each and every of these candle. So O stands for open, H stands for high, L stands for low, C stands for close. We'll see go in depth in that, but I just want you to grasp the concept of the line charts, because as traders, mostly the chart we use the most is the candlestick charts and then the line charts. Are we together? Remember, we already spoke about the market of an asset opening at a particular price of the day and closing at a particular price of the day. So we placed this here, and let's do this. All right, beautiful. So when you check down, you see that this is for Wednesday, January 8th. That is for today. This market opened at putting it on it. When you check to the top left corner, you will see 158.041. However, today has not closed yet. So since today has not closed yet, we cannot finalize the closing price for today's candle. So to let us understand the example better, let us go to yesterday, which is Tuesday. We can see that the details has changed. So that is to say, on Tuesday, the USD/JPY market opened at an opening price of 157.557. Remember, I spoke about the fact that this O stands for open, H stands for high, L stands for low, C stands for close. So the market opened at 157.557, and closed at 158.066. So what this simply means is that the market closed higher, but that's not what we are here to talk about. Just follow me. What I'm trying to say to you is the line charts, unlike the candlestick, you can see that the candlestick is showing four properties, but the line chart only shows one. Can you see? The close. Because the line chart always moves from the closing price of a candlestick to another closing price. I hope you get it. While for the candlestick gives us the property of the open, the high, the low, and the close. So we've talked about line charts, we've talked about candlesticks. However, let us check the definition of candlesticks again. It says candlesticks are type of price charts that shows the price movement of an asset over a period of time. They are a key component of technical analysis and used in helping traders interpret price information and identify trends. So long story short is that these things are what express the fluctuation in price that happens in the markets every day, every hour, and every minute. I believe we get that example. In case we do not understand, write your question and then you can ask on the group. So let's go back to where our curriculum is. And yeah, so we've talked about types of charts, candlestick, line charts, and bar charts. We rarely use the bar chart. It is mostly candlestick and line charts. That is what we often deal with as traders most times. Now, let us now talk about type of candlesticks and then properties of a candlestick. The market is always moving, and candlestick are things that just typify how market moves. I'm thinking of how to make the example and the illustration more simpler. Okay, so for those in Nigeria, you know that there was a point in time that $1 was equal to 500 naira, isn't it? And currently $1 is around 1.5K, which is 1,500 naira. What we are saying is that this candlestick is what now represents how price has moved on the charts. You know, in the real sense, real life now, we just know it's moved from 500 to 1.5. We can't see anything. But when you now open the charts, it is a candlestick that will now show to you that this is 500 here, this is 1.5 here. So naira to dollar has moved from 500 to 1.5. And in a situation whereby it came down from, I think it got to 1.719 at a point, and currently we are at 1.5. So it's moved from 1.7 down to 1.5. So it is candlestick that now puts a kind of embodiment expression to those movements on the chart. I do hope we understand now. So there are different types of candlesticks on the charts. Type of candlesticks on the chart, and basically there are just two types. We have the bullish and then we have the bearish. What does bullish means? Bullish means it's going up. Let's make it simple. And bearish means it is going down. Don't let's complicate things for ourselves. What that means is that, remember we spoke about when dollar rose from 500 to 1.5. You know, that's an increase in price between naira to dollar. So the candlestick that would express that change in price is called bullish candle. Why? Because price increase. That's just the name, bull. So someone gave an illustration which made sense, that why is uptrend or anything going up, why is it called bull, and anything coming down is called bear? So the person said that's because when a bull, you know, bull is an animal, bear is also an animal. When a bull wants to attack, he attacks from down up, like it goes up, and then when a bear wants to attack, it comes down, it pounces down on its prey. So bull, you get it, is going up, and bear is coming down. So what that means is that when you see a bullish candle, that means that it's moved from a low pricing level to a higher pricing level. And when you see a bearish candle moves from a higher pricing level to a lower pricing level. Let us bring this example home to make it clear. Remember, we said that candlesticks are what gives physical expression to the fluctuations in price. So when the market moved from 1 naira and $1 is 500 to 1,700, that's an increase. So the candlestick that will represent that movement in price is a bullish candle. Why? Because the price went up. Is it clear? And then when market got to 1.9 between naira and dollar, the market then came down back to 1.5. So the candlestick that will represent that price change is called a bearish candle. Why? Because the market moved from a higher pricing level to a lower pricing level. Those are the kind of two types of candlesticks that we have. So when you check the charts, a candlestick is either bullish or bearish. And what that simply means is that from the time the candle opened to when it's closed, for bullish candle, it means that it increased in price. Remember, we talked about the price that an asset opens for the day or for the hour. So that means that, for example, if the US dollar to Nigeria market opened today at 1.3 and then it's closed at 1.5, that's an increase. So that means that the candlestick that will represent today's price is a bullish candle. Why? Because price between the close and when it opened increased. But for a bearish candle, let's also now assume that the US dollar to Nigerian market opened at 1.8 today, and now it is closing at 1,750. That's a decrease. That's a bearish candle. Let us now make it more practical. Let us check through. We didn't say bullish candlestick pattern. Just give us bullish band candlestick mini. Good. Can you see? A bullish candlestick indicates that an asset price is either about to increase or is already increasing. Do you get the idea? And then for bearish too, a bearish candlestick indicates that the price of an asset is likely to fall or is falling already. So just to make it simple and driven home, those are the two types of candlestick that we have in the forex markets, and those are the names that they are called. So if you have an indication that the market should go up, you say that the market is about to be bullish, the price is going up. And if you analyze the market, you feel the market should come down, what will we say? The market is about to become bearish. So those are the two types of candlesticks that we have. But now let's talk about properties of a candlestick, because this is a candlestick right here. So the thing about the type of candlesticks that we have on the chart is that, you see, for some people, they give it different color. So for me, white, when you see a white candle, that means that the price went up. And when you see a black candle, that means that the price came down. The color of a candle is not what determines whether it went up or it came down. I need you to take note of that. That's one mistake we all make, of course. It's normal, in the industry, to just assume that, oh, white means it's going up, black means it's coming down. I'm saying so because Let me show you something. You can see this white candle. Let us count it. One, two, three. So we had one white candle and then two blacks. Let me show you something. No, that's a mistake. Let's do it this way. This is not turning out as I expected. What can I do? What can I do? What can I do? No, that's not what I want to do. Okay, let's make progress. Beautiful. Just follow me. I see that everything has become white. So in this scenario now, how do you now know which one went up and which one came down? So can you see that it is not the color? I just need to debunk that from the early beginning. And now it is colorless. Now I've given it colored body. You get the idea. What differentiates a candle really is the distance between the opening price and the closing price. So if the closing price is higher, remember higher, that's a bullish candle. If the closing price is lower, that's a bearish candle. That's the simplest way that you can use to differentiate between a type of candlestick, not the color. Because the same way you can see black and white on my charts, eh? I'm telling you, you can now go to somebody else's charts and what you will see, can you see? Uh, this thing is actually giving me a tough time. I don't know why, but let's check. Good. So can you see that now what I have now is what? Is blue. Did I just say blue? Sorry, it's purple and whitish red or whatever. The fact is you can give your candlestick any color you want. Sometimes when I'm bored, trust me, maybe I'm waiting for my trade setup to come to pass. These are some of the things I just play with on the chart once in a while, not all the time, just once in a while. What I'm just trying to pass across is that, in fact, let's leave it this way and then continue with our lesson. So what determines whether a candlestick is bullish or bearish is not the color. Remember, I spoke about the fact that earlier when you move this thing across each candle, you can see that the values are changing. So this is where you can check for the value of each candlestick. So when we have a candlestick whereby the closing price is above the open price, then we can say we have a bullish candlestick. Why? Because between when the candle opened and when it's closed, price increased. Let us make that more practical now. But let us first write something down. When the closing price of the candle is above the open, that is called a bullish candle or a buy candle, to make it simpler. You know that when you buy something in this market, you are buying it with the aim that the price will go up. And when you sell, you are selling with the aim that the price will go down. And then also, when the closing price is lower than the open, then that's a what? That's a bearish candle or sell candle. All right, good. So let us make progress together as we talk about the property of candlestick. Just follow me. Everything will make sense at the end. Every single candlestick that you will see has four properties: the open, the high, the low, and the close. The open, the high, the low, and the close. Let us check Google for reference as we make progress together. Okay, this one's just the show us pattern. But when we click on images, we should have something different and better. All right, great. Oh, great. Awesome. Can you see this? That's my opinion. Okay, it's my network. Oh, sorry. Sorry. All right. So you can see open, high, low, close. Open, high, low, close. Remember we spoke about the fact that the Forex markets always open at a price for the day, for the moment. And when I mean moment, I mean the hour. And then it closes as a certain price. Now let us write this out. The open, which is symbolized, which is O, the I, which is H, the low, which is L, and then the close, which is C. So in the Forex industry, one of the things I know that you will come across, one of the things I know you will come across again and again is this thing called OHLC, because these are the property of every candle. Every single candlestick on the chart has this thing called open, high, low, close. Every single one of them. You can find scenarios whereby the open is the same as the high or the low, and the close is also the same as the high or low. But that doesn't change the fact that it has an open, it has a high, it has a low, and it has a close. So, what does all this thing mean to avoid confusion? Open simply means that the price that the market opened for that day. As simple as that. Remember, we've used stock exchange markets, for example. And this is also the Forex market that we are using for another example. Meaning that when the market opened today, the market opened at a particular price. And when the time comes for the market to close, the market will also close at a particular price. That's the close. Now, what is high and low? High simply means that as price was fluctuating today, high is the highest price that the market got to before either coming down or going up. No, that's not it. High, that's the highest price that the market got to for that day before it's closed. And low is the lowest price market got to for that day before it closed. Remember that what we trade is fluctuations in price currencies, isn't it? So the price is always moving, up and down, zigzag, and even if it goes up, even as it's going up, there's a way it is still going up and down in a way. It is crucial that you understand this point because candlesticks are everything. The properties of candlesticks are everything that we do on the charts. When you don't get these points well, it might be difficult to understand other things. And that is why I'm taking my time to explain again and again and then again. So every single candlestick has that property. Open, the price is open for the day. Low, the lowest price it got to for that day before closing. I, the highest price it got to for that day before closing, and then close. That was where the market now closed for the day. I hope we get it and it's getting clearer. So let us enter the chart and check, for example. Now, this is GBP USD. And this is the daily time frame. We'll still talk about that later. Remember where we spoke about the fact that the difference between a bullish candle and a bearish candle is the price where the markets closed for that day. If the market opened and went higher to close above, that's a bullish candle because price increased. If the market opened and went lower to close below for the day, that's bearish because the market decreased. I believe that is clear. So I want us to take a very good example here. You know, let's hide this. We'll see need it. Let's bring this one up. Let's take this up too. Let's take this up too. Good. Now let's bring this one here. So let us take this candlestick as an example. Oh, this is today. So since today is yet to end, we really can't determine the closing price for today. So we'll have to skip today's candle and let's go as far back as, let's pick this particular candle. Let's pick this one. The candle on which I've put that horizontal line. Let me make it bigger. Let me change the color. Great. So this red line is on a particular candle. I remember I said that when you put this line, the cursor, on any candle, it will show you the details up above there. You can see O that stands for open. The market on this day, which is 19th of December 2024, opened at 1.25731. Let's write that down. 1.25731. And then when it was going to close, it closed at what? It closed at 1.25005. 1.25005. Now it's time to do mathematics. 1.25731 and 1.25005. Which one is higher? 1.25071 is definitely higher. So meaning that the closing price of this candlestick is lower. This is the closing price here. Remember, 1.25005. Look at it once again. 1.25005. Can you see that? So 1.25005 is lower, apparently, in value than 1.25731. So what does that mean? That means that for that day, GBP USD sold. GBP USD decreased in price. GBP USD was bearish. Do we get that illustration? That's how simple it is. Why? Because the closing price, remember, of the candle is lower than the open price. Now, we talked about high and low. When we remove this line, every candlestick has a property called the body and then the wicks. Look at it. Can we have anyone here? Okay, can you see wick? What's this? What's this stress that this thing is giving me? Good. So you can see that we have the wick here called shadow. The body, this is the real representation of how the markets move. These ones. Those wick indicates places where price got to, but price did not stay there. Do you get? Like price went that high, but price did not remain there. Price still came down a little bit. Price went that low. Price did not remain there, but came back up a little bit. So it leaves marks on the chart. And that mark is what we call the wick. So we have the high wick and the low wick, which is the high and then the low. I hope you understand. These are the properties of every single candlestick. So the eye, the top of every candle, this is what candlesticks have in common. The top of every candle is the eye. That's the top. The eye. You know that week I just showed you. The top of every candle is the eye. That is it. Let's label it. That is it. The top of every candle is the eye. However, let us go back to the candle that we are using for example. So for me, I've labeled every bearish candle color purple, and then I've made every bullish candle color white. So what that means is that when you see a white candle, that means that on that day, the closing price was higher than the opening price. I'm sure you remember. And when you see a purple candle, excuse me, it means for that day, the closing price was what? Lower than the opening price. That's exactly the way it is. However, for high and low, highs and lows in the charts are always the same. Highs and low in the charts are always the same. And what do they indicate? The high indicated that you see GBP USD on what date is this? 19th of December. It actually opened at 1.25731. But if you look at the high, you see that the value of the high is higher, which is 1.26664. But what it means is that although the market went that high, the market did not remain there. Rather, the market went that high and still now came back. Now that's the movement, the struggle between buyers and sellers in the markets. But Coco is you should understand what this candlestick means. So what it means is that when the market opened on this day, 19th of December, it opened at 1.25731. The buyers took it high as 1.26664. But the moment they got there, the sellers did not let them remain there. The sellers pushed the price down and also went lower. So the low, like I said, is also the lowest price that the market got to for the day. So either for a bearish candle, bullish candle, the high is always above, the low is always below. What is different is the closing price. So for a bullish candle, the high is above, the low is below, but the open is below and the high is above. Don't get confused. It can be confusing. Why is the close above? Because it's increased in price. And for a bearish candle, the high is also above because high is just up. High is high and low is low. But what is different is the opening price and the closing price. So let's label this one too as our low. Let's move to the left. You get the idea. So the high is the highest price that this market got to for that day, and then it came back down because the sellers pushed it down. And then the low is the least place it also got to for the day before the buyers pushed it up a bit, but it eventually closed at 1.25005. I believe that makes sense. So the reason why this candle is a bearish candle is because it's closed below the opening price. So this is the opening price here. That's the opening price. And then this is the closing price. So if I want to put value to these things so that you can see them here on the charts, I'll just do this. I'll go to settings. price level for all of them. All right, great. So can you see it? Remember the properties we saw here. The open. What's the open? 1.25731. If you check to the right part of the chart, you also see the 1.25731 here. Can you see it? That's because having labeled them, I allowed the price to show on the charts. And then you see 1.25005, which is the close, the low, 1.24946, and then the high. So that's it. So what differentiates between a bullish candle and a bearish candle is the closing price. This one now, you can see that it closed lower. Let me label this properly. Close. And then this open. Do you get it? So this one closed lower because when you check the values, let's look at it together. Once again, 1.25005 and the open 1.25731. Which one is lower? The close. So according to what we wrote here, that's a bearish candle. Now let's now move to the example of a bullish candle. Remember I said that when you see white, that's bullish on my charts. And I want us to use this particular example, this particular candle. So for this candle, both the low and the open, they have the same value. Low and then open. They actually have the same value. But there are candlesticks you will see that the low and the open don't have the same value. Like this one. We can see this is the low here. Now, let me stop using the crosshair. Good. You can see this is the low here. This is the open. This is the high. This is the close. I'm sure you get this. So when you watch it again and again, you will get it. So what's the low? The low is that when this market opened on this day, what day is this? January 6th or Monday. Look at the top left, you'll see the properties again. OHLC. What is the low? The low is 1.24085. What's also the open? 1.24085. So what this means on this day is that the moment the market opened, baga, the buyers did not even allow the sellers push the market down a bit. They pushed everything up down to the highest point that the market got to for that day, which is 1.25506, before the sellers were able to push it down a bit, and then they ended up closing at 1.25130. So what makes this candlestick a bullish candlestick? Let us look at the value of the close. What is the close? 1.25130. What's the open? 1.24085. When we carry our calculator, or even by checking it by face value, 1.25, 1.24. Which one is the highest? 1.25. So that means that the closing price is above the open, and that makes it a bullish candle. So we've spoken about the type of candlestick. We've spoken about the properties of candlesticks. That's because these are the things you need to know on the charts to look at a candle, to be able to determine the open, the high, the low, and then the close for that candlestick, either for the day or for the 4 hours. So having understood the candlestick, the types, and how to differentiate between them, let us move to the next lesson, which will be what? Let us unveil. Do we still need this? Of course, you can always check through it when you are going through your lessons again. Or you can take a rewind, take a screenshot, and familiarize yourself with it. So let's make progress. All right, so we've spoken about the types. We have just two types, a bullish candle or a bearish candle. And as we saw both on Google and what I explained, A candlestick is bullish because the price increased, and a candlestick is bearish because the price decreased. A candlestick is bullish because the price increased from the open and closed above. A candlestick is bearish because the price decreased and closed below. I hope you understand what I'm trying to say. So the next thing we want to move into now is what we call time frames. Now, for all the examples I've been using since, I've been using 1 day. This is the daily time frame. There are what we call time frames in the markets. And then we have the monthly. In fact, we have the 12 months. This is it here. We have multiple time frames, starting from the 12 months, which is 1 year, to 6 months, to 3 months, to 1 month, 1 week, 1 day, 4 hours, 3 hours, 2 hours, 1 hour, 45 minutes, 30 minutes, and 15 minutes. What all these things just simply means is that just as we used the daily time frame as an example, you see one candle that you are seeing here, just one, took 24 hours to form. And what do we mean by forming? Forming is that it opened, fluctuated high and low, and close. It takes 24 hours to do that. Now, when you go to the monthly time frame, what that also means is, this is the weekly. What that also then means is that on the weekly time frame, the same way one candle takes 24 hours to form on the daily, 24 hours make 1 day. On the weekly too, it also takes 7 days to form one of each of these candlesticks that you are looking at. It's important because these are the things that we can use to determine the overall direction. Don't worry, it's not flying over your head. If it is getting cumbersome, take a break and come back. But that is it. So when you also then go to the 12 months, you see them also. And the thing about candlestick is that the higher you go, the more they reduce because they are compacting into each other. What that means is you see these 12 months now, it takes 52 weeks, 365 days to form one of these candles. What that implies is that you see one candle like this, just one of it. Since this is a 12-month time frame, just this one, where I've placed that line, inside that one, you'll find 365 daily candles. However, the market is not open for 365 days. It is only open for 5 days a week, and of course, 52 days in the year. So, and that's how many days? Let's check it together. That's 5 times 52. That's 216. So what we are saying is that inside this one candle for the yearly, it contains 260 daily candle. That is why it is shrinked. It took 1 year to form, remember. So inside that one is 360. And then when you now scale down to the monthly time frame, since it is 12 months, it also means that it contains 12 monthly time frame candles. Do you get? But let's now go back to the 1 minute and then build it all from there. So that's for easy understanding. Then let's do 5 minutes. Yeah, I think we are good like this. So this is 1 minute. On 1 minute, you will see plenty candlesticks because it's 1 minute now. You get the idea. So what we are trying to say is that you see each and every of these candles as it's forming now. You can see that you can clearly see this one moving. You can see it fluctuating. Did you observe that when you were checking for the yearly, it didn't even look it didn't look like that candle was moving at all because it's huge, heavy. It may not look like it's moving. What's 1 hour time frame? Because we have what we call time frames. Let us check Google again. Maybe Google could, even make it simpler for me. What are time frames in trading? A time frame in trading is a set period of time that shows price action on a chart. Time frames are important because they provide traders with actionable insights into the market. Let's look at this one. The amount of time that a trend lasts for in a market, which can be identified as and used by traders. That is simply what time frame is. Going back to where we're coming from, meaning that the amount of time it took for this candle to form one of these is just 1 minute, just one. In another minute, can you see the previous one has closed, another one has showed up. Then we go to 2 minutes. What 2 minutes also means is that it took 2 minutes, just 2 minutes. Oh, this trading view can open 2 minutes, but it can open 5. Good. So what each of these means is that it took 5 minutes, just 5 minutes, for each of this candle to form. And then 15 means that it took 15 minutes for one of them to form. So what that means is that this 15 minutes candle contains 15 1 minutes candle. Do you get? And 3 5 minutes candle. You get the mathematics. And then 4 15 minutes candle makes up 1 hour. Sure you get? And then 4 1 hour candle makes up 4 hours. This is the 1 hour here. This is 2 hour and 4 hour. So they are just interwoven. Although primarily as trader, the time frame we often deal with the most is the weekly, the daily, and the 4 hour. Weekly, because we want to have a weekly outlook. We want to know the direction of the market for the week. Daily, because we want to know the direction for the day. And 4 hour to look for opportunities to trade. So we've talked about time frames, how long it takes for a candle to form. I need us to, sit down on this and then understand everything that we've spoken about from candlestick, what they mean, what a line chart is, what a candlestick is, the type of candlesticks that we have, how that the difference between a buy and a sell candle or bullish and bearish candle is the closing price, not the color. And they will spoke about the properties of every candle across every time frame. Every candle has its own property, which is the open, the high, the low, and the close. Every time frame candle has its own properties. And remember that those properties are just the pricing level of the assets that are related together. So we've spoken about time frames and how long it takes for a candle to form. So the next thing we have on our timetable will be what is a pip and a pipette, how to count them, bid and ask price. What is a spread? Remember when we were talking about how to open an account, we were seeing zero spread accounts, premium accounts, and on and on. So that is where we get to talk about those kind of things and what they mean. So if you've gone through baby pips, these are things that you would have seen, and I'm just trying to break them down so it can be simpler and easier with the chart representation. All right, guys, please do everything you can to take good care of yourself. I will see you on the other side in the next video. Cheers and God bless.